Thank you for joining us for the Think Tank Exchange. Today, we're with Tony Arsta, portfolio manager at Motley Fool Asset Management, and we're going to have a great discussion around global investing and active management. So, Tony, thanks very much for joining us. Please tell us a little bit about yourself. Let's just start off broadly speaking.
Yeah, good morning. I'm happy to be here. So my name's Tony. I work at Motley Fool Asset Management as a portfolio manager. I've been at asset management since we launched our first mutual fund back in 2009. That mutual fund eventually became what is now the global ETF. So we've gone through a couple name changes and some structure changes along the way. But I've been involved in this for 15 years now. Prior to that, my undergrad degree is in computer science, so I got kind of that tech background. Realized I was a terrible programmer, so I went on to get an MBA, study finance, and luckily found myself in the career I'm in now.
And Tony, I'm the guy who always talks about how structure matters, right? And you guys did something that was very early in that you converted from a mutual fund to an ETF, right? Talk through your experience with doing that, if you would, and then you as a portfolio manager, what role did you have?
Yeah, it was nice that our president Kelsey Mowry was able to do almost all the heavy lifting in terms of the filings, that sort of thing. There was, I believe, only one firm that had done a mutual fund to active ETF conversion prior to us. As soon as we saw that they got approval and that went through, we started the paperwork and doing our end of it. So I don't know that we were second, but we definitely started as soon as we saw that first one. We had great partners working on everything. So as the portfolio manager, all I really had to think about was, what do we hold in the funds and how would that be different with ETFs? As you know, we have to disclose our positions daily. So were there any concerns about illiquid positions, anything like that? Given how we manage, not really. The biggest issue with the global fund was a few markets. Korea comes to mind as a market where you have to have investor IDs in order to do transactions. So the way ETFs are different from mutual funds is through in-kind transactions, where someone creating a basket of shares will hand over securities rather than just giving us a big pile of cash. And with certain foreign markets, that can be tricky, both in terms of those restricted markets and even the unrestricted ones, time of day, making sure you have all the securities valued as of 4 p.m. Eastern time, and having to deal with markets that are open at different hours around the world. So a little bit of learning to do there, but really it went as smoothly as I could have hoped.
Yeah, it's funny when I've been involved in portfolio management for 30 years, and as a portfolio manager, I often just think I'm supposed to buy low and sell high, right? And look over the portfolio about risk management and really do the security selection process. But then, today you've got to do a lot of other things as a portfolio manager to make sure things run smoothly. So I want to pivot a little bit and talk about how you guys add value in the way of high active share. Talk through a little bit about the culture at Motley Fool and speak to the reasoning on how you have such high active share in your portfolio construction.
Yeah, it starts with the basic principle of we want to own high quality companies. We're not interested in trading stocks. I don't know that we would have an advantage over all the high frequency traders and others that do that sort of thing. The people that aren't high frequency but are watching quarterly movements, that's a very difficult game to play. Not saying it's an easy game to play, but buying and holding companies just makes a lot more sense to us. So if we can find a great business, determine that we like the quality of that business, we don't want to be making knee-jerk reactions based on a stock price moving 5%, for example, when we could just hold a company. Several things we've held for over a decade now. So that makes sense to me as the way to go in terms of adding value. And it goes through our whole culture of how we do things. We have a quality assessment process for each company we hold. We rewrite the thesis on each company we hold each year. So we're always looking at and updating those things, but we're taking it from a business first perspective for sure.
If you would, we talked to Charlie last month about your quality metrics, right? Walk through, just so everybody's on the same page, the things that you all are focused on.
Yeah, and one of the things I like about these, we call them our four pillars. And the job of being a portfolio manager or analyst today is so different from 10 years ago, 20 years ago, 30 years ago, in terms of the data available, the screens you can run, the ways to get that information. So if you're just trying to find a company with high margins, for example, anyone can run that screen. So we look at a mix of qualitative and quantitative factors. The first pillar is management, culture, and incentives. So we look at the management team who's running the company, how are they incentivized, and also how do they talk about the business? What do they care about? There's plenty of people out there that just want to build an empire that don't really care about that return on capital per se. So we look at that. I also like to dig down and try to look at some of the lower level culture, such as how the sales team is incentivized is always a fascinating thing for me. So that's pillar number one. Pillar two is the economics of the business. That's the most straightforward, traditional analysis of return on capital, margins, whatever you learn in business school about the economic side of a business and how to run a successful, profitable company really fits into that economics pillar. Pillar number three, competitive advantage, again, is a concept that's unique to us. People like Warren Buffett have talked about it. Morningstar as their moat ratings. But that's important because we like to hold companies for the long run instead of trading stocks. We need companies that do have some sort of durable advantage. And then pillar number four is what we call trajectory. And that's the most qualitative of those four pillars, I would say. That one is looking out 5 years to 10 years from now. How do we see the company? And that allows us to focus in on a couple things. One is the company strategy, whether they can grow as a business, either take market share or have some other way of growing. And then it also allows us to focus a little bit wider on the industry. Owning a great company in a slow or bad industry is not necessarily our approach. So when we look for great businesses, we want to make sure they're in the right playground to be able to take advantage of the opportunities. That can be difficult if you're great, but your opportunity is shrinking. That would make it a little bit harder for us to want to own those. So we combine those four pillars. We come up with a quality rating on every company. And then from there, obviously price matters, portfolio composition matters, but every company that we own, we start by thinking about the quality of the business.
Yeah, I mean, maybe we'll get to this later, but how do you balance between quality and valuation? I mean, at what point, as an example, I mean, this is an art, not necessarily a science. So let's be honest about that, right? But is this part of your investment committee discussions? And along those lines, I got to have some fun with this. What exactly is affectionate hostility?
Yeah, affectionate hostility. That's a phrase that we've been using for many years now. We've kind of stopped using it more recently, but it still matters to us. The basic concept of it is that we want to attack ideas and make sure that what we hold in the portfolio is the right companies. So if we're dancing around each other, afraid to hurt each other's feelings, no one on this team is a jerk. We all like each other and get along. So that helps. If we didn't have that, you couldn't have the hostility part. But since we all get along, we can take our ideas, bounce them off each other, be honest with each other when we think an idea might be lacking in a way. And I think that results in a better portfolio product. So just to back up a second, at our team level, I'm one of 9 people on the team between portfolio managers and analysts. I mentioned we have these 4 pillars of quality. So if I'm doing research on a company, I'm leading on that company, for example, before we buy it, once I've done my work, I will take each of those 4 pillars and assign one pillar to a separate person on the team. So of the 8 people I work with, 4 of them are going to take one of those 4 pillars, do their own work on it. Then we get together as a group, discuss it, and that's where that affectionate hostility can really come out if there's any disagreements about the idea there. So yeah, we're definitely digging in. Given the size of our team, we spend a lot of time thinking about every company before we buy it. We don't, as our CIO, Brian Hinman, always says, we don't want any strangers in the portfolio. So we definitely want to be aware of what we're owning before we own it.
Yeah, and I like that you guys write it down, right? Put it in the file, and then everybody can go back to it and reference what was said, what was discussed, what was concluded. And does that mean also that you review the holdings across each individual portfolio on a regular basis in the weightings? And how do you manage through that as an issue, both in the context of making a purchase, but frankly, also in making a sale?
Yeah, that's the tough part, and why portfolio managers get paid to do what they do. And it's not just a computer doing it. As you said, it's art. There's some science involved, but a big part of it is thinking through things that are unknowable. So you mentioned all the things about being a portfolio manager that you don't think about. You want to just pick good stocks and hold them. There's all the regulatory sides and making sure trades settle and that side of it. But at the end of the day, where I like to spend my time is just staring at a list of our holdings and the weightings and thinking. So almost like a form of meditation, where I'm just looking at what we hold, thinking about what could go well, what could go wrong with this company, and then what are the ripple effects across the whole portfolio. If a retail company, for example, that we hold does poorly, how does that ripple through the portfolio? What does that imply about the macro economy? So trying to think about that sort of thing, combining it with a realization that none of us know the future. This was more cool to say 3 or 4 years ago when everybody loved the Marvel movies, but thinking about the whole multiverse concept, and there's a few different futures that could play out. Only one of them will in our reality. But if we build a portfolio that will only succeed in one version of the future, there's a very good chance we're going to mess it up. So we need to build resilient portfolios that can handle different types of risk. And most of those hopefully will never come to pass. But yeah, that's the art side of it, is just thinking about all those things. And then given how concentrated we run each portfolio, the global fund, for example, has just over 40 holdings. That really makes the sell discipline, I don't want to say easy, but it divorces the sell discipline from someone that's running more of, say, a closet index where they can just sell a company and then invest pro rata in the index. We have to kind of marry those buy and sell decisions together. So when we have a new idea, where's that cash coming from? When an idea falls down our list and we want to trim it or get rid of it, what do we do with the money in those cases? So it all kind of blends together. And if I don't get to spend half my day just doing what appears to other people to be not working, just sitting and thinking, then it makes it harder to stay up to speed on all these different portfolios.
Well, Tony, you're not just sitting there thinking. Are you talking to management and drilling deep into your due diligence process and doing checks and balances on a regular basis?
Yeah. everyone on our team has a responsibility to be a lead analyst on several companies. Of the whole team, I am the lead analyst on the smallest number of companies. So I'm able to focus a little bit more than some of the people on the team, some of the analysts that have more companies to dig through. But yeah, we definitely get out there, talk to companies, read all the reports we can get. We're not just sitting and thinking about it in a vacuum. We're absorbing new information and then incorporating that into the thoughts as well.
Now, you and Charlie have a common background in that you both came out of school and became an analyst and then ultimately became portfolio managers at Motley, right?
Right.
I think that's so cool and probably unique, given your size of a firm, right? Because we often talk about culture, but that's part of your culture that you started from scratch effectively and grew up and worked together for so long. So, but where I'm going on this, Charlie has a background in biotech, right? And you have a background in computer science, right?
Right.
Should we expect the portfolio that you lead, the global portfolio, to have a tilt towards that expertise? I mean, I think you're about 20% in internet and technology. Maybe I'm oversimplifying it, but is it coincidental or is something we should be looking for?
I don't know that we would necessarily have a tilt there. It's interesting. I think we definitely view that, going back to our 4 pillars and the trajectory pillar. A lot of these internet companies, software companies, have a great trajectory in front of them over the next decade or so. It was interesting listening to Charlie's interview and his background doing lab research while biotech companies were on fire back during the .com bubble. Biotech was hot as well. That's also the time I was in college getting my computer science degree. So I was seeing all these tech companies that were just getting insane valuations while I was trying to learn how to code. And the first stock I ever bought was, I don't know if it was the exact day, but it was definitely the month of the NASDAQ peak. So I lost something like 90% of my money on that first thing I ever bought. Luckily, I was a poor college student, could only put in maybe $100. But I think that has shaped me to this day in terms of how I think about risk and think about downside protection as well as the potential upside. But over the years, one of the things I learned was I don't want to say my computer science background hurt my investing, because I've learned from it and I've grown. But in those first few years, it definitely, there were a lot of companies I would look at and I would think, I wasn't even that good at writing code and being a programmer, and I could kind of replicate this on my own. I could make a system that does this. I'm not buying this stock. And what I realized is the tech piece of a software company, of a tech company, is an important part, but doesn't matter nearly as much as a couple of things. One is a user interface that people that aren't computer science majors can use. I have no problem sitting at a text prompt and typing in commands, and that's just not how most people use their products. The second part is a sales team. Going back to the early 2000s, Red Hat Linux was a big thing, and it was baffling to me for several years because it was an open source free thing. Anyone could get a free version of Linux and install it on their own. So why is this company making so much money? And it was the combination of their sales team, their customer support, all the things that help people actually use technology as opposed to just having it exist. So I think that's kind of gone through, and the rest of my team that doesn't have the same background as me, I've pounded that idea into their heads so many times that I don't want to own a software company that doesn't know how to sell their product and doesn't know how to listen to customers, because there's so many smart engineers and programmers out there that can replicate technology. But if you don't have that user interface and that customer experience, it's just not going to work.
Yeah, we're very cognizant of that issue at Title. I mean, and it's really, really hard to stay focused on what is the customer experience. But at the end of the day, I think, especially at a small company, everybody's going to have an impact on revenue, right? And if you're not focused on the customer experience, at some point you're gonna miss a cycle in business, or you're gonna find out that your product has deteriorated. So I totally follow you on that and agree with the philosophy. Okay. One last broad question. I guess we've kind of covered it in the context of sector. So I'm going to pass over. We're going to jump now into stock specific, the kind of like the fun part for me, at least. Not that this hasn't been fun. So let's start off with Iconic, right? Or Icon rather, PLC. It's one of your top holdings.
Right.
How did it come about? How long have you held it, roughly? How do you view it, and why is it in the portfolio?
Yeah, that one is a top holding that we've only held. We first bought it for the global fund in 2021, so just a few years ago. But it's a fascinating business. Post-COVID, a lot of healthcare companies have gotten attractively valued because of how much R&D effort was spent on a COVID cure and how much disruption there was in terms of medical procedures and everything. There have been a lot of price disconnects within the healthcare industry. But Icon is a contract research organization, which in simple terms is a way for biotech and pharma companies to outsource their R&D. And specifically the R&D part of doing clinical trials. So if you're not familiar with the pharma industry, once a drug is developed, it first goes through a phase 1 trial just to make sure it's safe, phase 2 trial, phase 3 trial. All of these trials need thousands of people to either have the drug or have a placebo. It takes years, costs a lot of money to do these trials, and then it goes through FDA approval once the trials are complete. So what Icon does is they have a global expertise in recruiting patients for these trials, structuring everything, doing some of the data analysis, really making what had been a fixed cost at a lot of these pharmaceutical companies kind of a variable cost for them. They can just hire Icon rather than having to have the in-house expertise to do something that you might not need to do on a regular basis. If you're a smaller drug company and you're not hitting a phase 3 trial every year, having the know-how and expertise to do that could be quite expensive. So Icon, they found a nice little niche there where they can really focus on those clinical trials, helping these drug companies get their trials through. There's some trials where you need to recruit a very wide base of people. There's others where you're talking about a rare disease and you have to dig through haystacks to find a couple people that are maybe eligible. So being able to do all of that is quite the skill to have. And yeah, they've positioned themselves quite nicely to do that globally.
Another name that I wasn't familiar with was Watsco. Can you talk to us about that holding as well?
Yeah, it sounds like such a simple company. They do HVAC and refrigeration equipment, so they'll distribute furnaces, heaters, air conditioners. So it's a very basic, simple business in that regard. But if you think about the landscape of HVAC, it's very fragmented. There's, no matter what city you're in, you look in the phone book, you'll find probably a few dozen different HVAC companies that can come out, try to repair your furnace, sell you a new one. But there's a lot of fragmentation there. And as we've seen with other companies, trucking comes to mind. When you have a lot of fragmentation, someone that can do M&A can roll up companies, and at the same time can introduce a little bit of technology into it to try to make it more efficient, it gives you nice room for growth there. Watsco's done very well because, again, with COVID, a lot of people sitting at home decided, I need a better air conditioner. I need to upgrade what I have around the house. Also, as we've all seen with home prices over the last few years, there's been a lot of new construction. So they've had a nice tailwind the last few years with, there's a replacement cycle of HVAC equipment, and then there's all the new construction. Both of those things have been working well for them over the last few years. So it's worked very well for us. So the trick now is, when will that cycle end? I think if you look at our holdings, we've been in the last year and a half, 2 years, speaking of sell discipline, that's one where we've trimmed it regularly to add new ideas because it seems like some of that replacement cycle may have slowed. Turns out if we had never trimmed any of it, we'd be doing much better. But that's one of those things where we just can't quite hold. It's done so well for us. We've used it to finance other new positions. Nice,
well, that's risk. Yeah, but it's risk management.
Right.
To give up a portion, both either maybe of the profit, but lower your risk. That's what you're supposed to be doing, right?
Right.
I totally respect that. Selenex, can you talk about that one as well?
Yeah. So Cellnex, that's one where since we first bought it has gone down quite a bit. We've added more. We still like the story, but it hasn't worked out yet. But if you're familiar at all with cellular companies, tower companies in the U.S., so the two we currently own there are American Tower and SBA Communications. In the U.S., roughly 80% of tower companies are held by these third parties as opposed to, say, an AT&T or Verizon. And the nice thing about that then is, if you think about a cell tower, it's just a big piece of metal out in the field with equipment at the top of it. If a third-party company owns that, they can have multiple tenants. They might be able to get T-Mobile, AT&T, and Verizon all in the same tower. So in the U.S. right now, we're looking at somewhere between 2.3 to 2.5 tenants per tower. So once you build that post, you get all the wiring to it. You get that first tenant at a slightly profitable margin. You add tenant number two, and the margins are, they're not 100%, but call it 80, 90% margins on that second tenant. You got a third one, it's even better. So it's a fabulous business. And then you think of the maintenance. Once you put up that tower, maybe you have to go paint it every couple of years, but the maintenance CapEx is very low. So in the US, about 80% of the market now is these third-party tower companies. In Europe, it's still only about 30 to 40%. The rest are owned by the cellular companies themselves. So our thought there is, over time, we'll see more of these cellular companies divesting of the towers they own, selling them to third-party tower operators like Cellnex, who can then add more tenants per tower. So I said in the US, we have about 2.3 to 2.5 tenants per tower. In Europe, it's a little bit less than 1.5. So there's room there to put more equipment and more tenants on each tower. And the economics of the business, we already know can be excellent. They are excellent for Cellnex, but there's room for that expansion. As you see more companies be cost conscious with where they're putting their money, it just doesn't make sense to build that tower yourself if you can just have a third party do it and share the cost a little bit. So that's one that hasn't worked for us yet, but that's another one we bought post-COVID in 2021 that the story itself makes sense. And we've held the US-based tower companies for over a decade now, and we're very familiar with the model and how it can work well for us.
Yeah, it always feels good, maybe to give some of the stock away, sell some of the stock when it's done well for you. Sometimes it feels good. Sometimes it's like giving up a little bit of the baby, but it's harder to buy something that hasn't worked. But I get your point. If you're looking at things from a long-term perspective, it's just a question of, does the business model work? And, clearly you've got convictions around that. And, when I look at some of the REITs ETFs, I see some of these companies in there, and you just explained perfectly why they are considered kind of a REIT model, which is like a steady Eddie kind of thing. I totally get it. So I'm going to just like randomly throw out one last one, which is Waste Connection, just going down your list and your top holdings. And then I want to have some more fun with you on another question.
Yeah. So Waste Connections, the name isn't as familiar as like a waste management. They're the largest waste company in the U.S. Waste Connections is the third largest in the U.S. They're actually domiciled in Canada, but they do a lot of their business all over North America, including the U.S. So they're the third largest. They don't compete head to head with Waste Management or Republic Services, which is the second largest. They go into other secondary, sometimes smaller markets, but the economics of that business, I mentioned before, trucking, and we were talking about Watsco and the HVAC business. Waste hauling is a very similar thing, where it's a very fragmented industry. You have a couple of the big companies out there. The fascinating thing is how landfills work and how that's really changed over the last few decades. We're not really getting more landfill capacity in this country. It's getting harder to get permits for new ones. Some legacy landfills from 50 years ago have been shut down for environmental reasons. So if you have a landfill that's open, you can kind of have a monopoly there and make good money on that. I think Waste Connections gets somewhere around 30 to 40% of their overall revenue from managing the landfills themselves. And then the other side of it is the hauling, the waste hauling, getting the trash from a home or a business to that landfill. That's still a very fragmented mom and pop type industry, but they still need to dump their waste at these landfills that are held by the big companies. So if you own the landfill and you have the waste haulers, you can do a little bit of a price competition there, where you're able to, you're paying yourself the fee for tipping that trash into the landfill. So you have a structural advantage over the mom and pops that are just hauling and don't own a landfill. Also, as you grow and you maybe acquire some of these smaller businesses, you can use technology to optimize your routes, go on a more efficient pickup routine, which saves you money on trucks, repairing the trucks, gas, employees. All of it is made more efficient by technology. So that's all good. And then on top of that, you have a business where people are willing to pay whatever rates they're currently paying for trash, and then you can increase prices with inflation plus a little bit every year, and no one's really going to bat an eye. Waste pickup isn't something that's a big enough part of your overall home budget that you'll fight it too much, and you need that trash hauled away. So the pricing power within the industry is excellent, on top of the whole roll-up potential and all the parts of it that make the assets valuable. It's a fascinating business, Stone.
I never thought about waste management stocks as an inflation hedge.
Yeah, no one's going to stop having their trash picked up.
No,
inflation side.
Yeah, you don't think about it, and then I guess in most cases, I don't really know how to shop around for somebody else to come pick up my waste. Maybe there's one other firm who would pick it up.
Well, having moved into the mountains of Colorado recently, I can tell you, shopping around for different local haulers is not a fun and easy thing to do. It can be tough to get on some of those routes.
You had to rub that in, right? Yeah, the Colorado thing to me. Thanks. So I was surprised, but maybe I shouldn't have been, to see, a railroad in your portfolio. People talk about Warren Buffett as a railroad guy, and how does a railroad fit into your portfolio?
It's interesting. I'll have to shout out one of my colleagues, Mike Olson, on this one. If you look at the names that he's added to the portfolio, a lot of them are asset heavy businesses, I would call it. So you think of, people talk all the time about asset light business models, getting good return on capital. He has tended to find some companies. Waste Connections is another one of his that I mentioned, the landfills, holding unique assets that are expensive to replicate can kind of give you some pricing power and structural advantage there. So Waste Connections is an example. Canadian National Railway is another example. Those things where if you want to just try to copy their business model and do it, it's going to take you years and billions of dollars, and not to mention all the know-how of doing it. So Canadian National, I want to say it's about half of their revenue is what's known as a low value to weight ratio. So things that are very heavy and not cost effective to move. So things that are cheap but heavy. So if you think of like coal, for example, it weighs a lot. It's not worth as much as like a gold bar. So it's you need big equipment to move a lot of it and a lot of weight. And trucks really can't do it, especially if you get up north and think about the Canadian wilderness, some of the areas up in Western Canada, and trying to keep those roads clear for truckers. It's not feasible, and it costs a lot more to haul things by truck than it does by rail. Canadian National is kind of unique. I believe they're the only company that has ports on the Pacific coast, the Atlantic coast, and also the Gulf Coast of North America. So they can haul heavy things long distances across the entire continent at a price per ton, price per mile, however you want to break it down. That's just more cost effective. And then that one specifically, when we bought them, they were really struggling. There's Canadian National, I'm blanking on the name of the other railroad, and then there's BNSF owned by Berkshire Hathaway. Those other rail companies had really improved their operations and found some efficiencies that Canadian National had not yet worked into their structure. So having something with hard to replicate assets, pricing power, a steady demand, and then having room for operational improvement, it's a nice combination there of trends that we think can go in our way.
Yeah, I mean, I don't even think you could build a new railroad.
Getting the permits would probably not be possible.
Yeah, no. So you mentioned something about, owning and buying more of a stock is hard to do when it's going against you. And we've all had that experience, right? PayPal has been a tough hold for many people, right? And many investors, portfolio managers this year, right? A couple of years back, it was a ridiculous home run.
Right.
It had some, management change that was pretty well telegraphed, as far as I could tell. How do you handle a management change when you see a stock going down? Talk to us a little bit about PayPal and your experience with that, and how it fits with your overall philosophy.
Yeah, it can almost be harder when the stock is going down because you're rationalizing a bit more of it. With PayPal, not only the CEO leaving, but you had some turnover at the CFO level, other high level people. There was quite a bit going on there. And if the stock had been priced for perfection at that point, maybe we would have gotten out of it. When we go back to our 4 pillars of quality, that management, culture, and incentives is a big piece of it. But it's one of 4 pillars. When we looked at the competitive advantages, looked at the trajectory, we still liked what we saw there. So the quality rating dipped down a little bit. That made us a little reluctant to buy more of the stock. I think we eventually did buy more when it got cheap enough, but we weren't in a rush to buy more because we did lower that quality rating. As I said, we kind of review our thesis and rewrite that thesis every year. And I think you get to a point where I know a lot of people are afraid of like kind of revising and redoing a thesis and holding a company through it. There's times though where you have to think of it as a fresh new idea. The original thesis broke, that didn't work out for us, partly due to management turnover. But then from that point, deciding what to do next isn't as simple as the thesis broke, so let's never look at this again. Let's write a new thesis, see where the valuation is now, and decide if this was a new position starting from scratch, what would we do with it today? And we kept it in the portfolio and added a little bit more because we kind of like the vision of the new CEO. It took a while to get from the old CEO leaving to the new CEO, but his vision at PayPal and what he's established is something that we think makes sense. We also think the stock got beat down a little bit from day one. From our original thesis, we liked a part of the PayPal business called Braintree, which is kind of a white label payment processor side. So if you take off the PayPal name, you take off the brand names that consumers know, Braintree was that business that allows a lot of e-commerce operators, for example, to collect payments. And that is a lower margin business. They get less operating profit per dollar of revenue from that business, but it's a very stable and good business for them. So over the last few quarters, as that business has held up well and grown, it's actually caused their overall corporate margins to come down. So we kind of viewed that as an opportunity to buy what we believe are still high quality assets at a better entry point. We have to admit that our original entry point was bad. We lost money on that, but it's all about what happens in the future going forward. We can't make decisions today based on.
Yeah, the market was different, a year or two ago for sure. And the interesting thing about PayPal is it's got great free cash flow, right?
Right.
Is that something that you look for too in your quality metrics?
Yeah, that's definitely embedded in that economics pillar. It kind of goes through all the pillars, really. When you think about companies with great free cash flow, we usually have to look at what management is doing, the decisions they're making, either to get to that point of cash flow or then to look at how they're spending it. Are they hoarding it? Are they making subpar acquisitions? Are they paying dividends, buybacks? What's the capital allocation strategy? That capital allocation is a big part of management culture incentives. The free cash flow itself, the margins, the growth of that cash flow, stability of the cash flow, all goes into that economics pillar. And then the odds are good that if you have free cash flow, people will be coming for it unless you have that competitive advantage. So we need to look at that as well. So you kind of combine all those things. We go back to what I said before about we're not looking to trade stocks, we're looking to hold high quality businesses, and it comes down to cash. You gotta generate cash and do smart things with that cash.
Which is a great point, and got an inbound question from somebody regarding your sell discipline. I mean, listen, we're all wrong sometimes. What happens when something's not going your way, or what makes you sell when things aren't going your way? And can you give a specific example?
Yeah, so just looking at what we sold recently, I'll pick on our CIO, Brian Hinman, and one of his ideas with Cardlytics. That was a company that it's actually not sure if it was classified as software or industrial, but they would do some of the work to help credit card companies track and follow along with what customers were doing with the credit cards. So if you have a Chase credit card, for example, you might get some emails that say, this month, if you spend money on this category, we'll give you a little bit more off. Not the credit card that does the quarterly regular thing, but sometimes you get those one-off marketing emails. And Cardlytics really helped with that approach, being able to figure out where customers were spending their money, how you could nudge a customer to maybe use that specific credit card more rather than something else in their wallet, kind of tracking the overall market and giving analytics and data to these credit card firms. And by doing it as a third-party company instead of doing it in-house, you're able to kind of combine data from different credit cards, collect more user information, and sell that product. That all sounded like a great idea. It did not work out for us. There was a lot of pricing pressure. A lot of couple things went wrong there. One is that credit card companies' appetite to share data versus doing it in-house did not work out as well as the early indications had been. So it started to do well, and then once it got to a certain scale, the companies pulled back a little bit. The other part was just really an ineffectiveness in terms of those offers that you get through email to get a little bit of a discount to use a specific credit card. Didn't really perform as well as we had hoped. So all that combined to make the cash generated by the company a little bit too weak, and we had to eventually sell that one to raise money for new ideas. So yeah, a lot of what we do, since it is kind of qualitative focused based on a lot of the companies we've talked about so far, I'd kind of describe as storytelling, like telling you about these landfills and things like that. I'm not really getting into the metrics with you, but the idea of less landfills and mom and pop companies having to pay a fee that the roll-up company can avoid. We try to keep it simple like that and tell a good story with the investment, and then sometimes it just doesn't work. Other companies like Teladoc, for example, was one that took off during COVID. And then the evidence post-COVID is that, a bit surprising to me personally, less people want to use telemedicine when they can go to a doctor. I personally am a big fan of telemedicine and think being able to sit in front of a screen and talk to a doctor for certain things is helpful, but that's another one that didn't work out for us. We have to follow the evidence there, and when the demand just isn't materializing, the trajectory pillar specifically for that Teladoc business, on paper it sounds like it should work, but we're just not seeing the data to support that right now.
Well, sometimes you're also, coming from the vantage point of your own personal experience, right? So you live, I hope this is not a bad thing to say, but an obscure place in Colorado, right?
Right.
Driving an hour to see a doctor versus, spending 15 minutes on Zoom or whatnot, right? Makes a whole lot of sense to you. Yeah. Having said that, when I'm in New York City, I can schedule an appointment. My doctor actually is 1 block away. It makes more sense for me. So, speaking of personal experience, I forgot to ask you the question, given your technology experience, right? As a data scientist, AI, we haven't touched on it. We've gone almost an hour. We didn't touch on AI. Yeah. How does AI weave through your 4 pillars in your mind, in your process of investing? Yeah, that's the question.
Yeah, that's another area I mentioned before, how one of my early learnings in investing was not to focus on the technology. You need that platform in place. You need the sales team in place. Over 20 years ago now, when I was an undergraduate, I spent 1 semester taking a class specifically on AI, and a lot of the structure and process that you use for AI today is the same as what I learned back then. And a lot of what was written in my textbooks back then had been written 30 years prior. So the idea of how to structure these things hasn't changed much, but what has changed is I don't remember how many zeros to add to get from the computing power from when I was a student to today, but it's something on the order of like 1 trillion times more computing power. So these structures that you could build when I was a student weren't really useful because they took months to do what can now be done in less than a minute. So you need that infrastructure. You need the chip companies like an NVIDIA to really allow that processing power. Now that we've gotten to a point where you can actually do some fun, useful things, you'll notice that companies aren't really new to this. Like companies like Alphabet and Microsoft have been researching this and working on it for years. It's just now hitting the public consciousness in a lot of ways. But we're at a point now where you have to make the decision: do you want to own the classic pick and shovel type companies that allow for the infrastructure? You want to own the chip companies, the companies that have the platform, companies that can benefit from it. I don't know yet. I think one of the problems is these large learning systems need a lot of data. And if you have an open source system, anyone can replicate it. That goes back to what I was saying before about Red Hat Linux, for example. Why were people paying for something that was free through open source? So you need a company with a good platform that you can easily log into, get the results you want. People are still experimenting with ChatGPT, don't really know how to use it yet. I think a lot of people that are using it aren't sure what to type in and what they want to get out of it. So we're still in an exploratory phase there. The opposite side of the open source is having proprietary data, and I always think that's valuable. So I think companies like Alphabet, for example, which we've held for well over a decade now, they certainly have some proprietary data that other people don't have. So that's kind of where I'm thinking about and looking is who has something unique. You can buy some of the hardware companies that make chips for these things. That will give you an advantage for a few years as we go down that cost curve of chips and everything improves. That's an advantage that will eventually dissipate. Companies using AI, I remember over the last decade or two, the number of brick and mortar retail companies that tried to claim they had an advantage because they were big and early in e-commerce. Like that may have worked for a while, but everybody's doing it now. So if you are trying to run a business and claim you're using AI in a unique way, there's a very good chance you're not doing anything unique. And if you are, there's a good chance you might have employees leave and go work for someone else and take that knowledge with them or start their own business. So there isn't much of a durable advantage that I'm seeing in using AI. So then we're back to the data side of it. Who has the unique data? Who has a proprietary data? You mentioned Alphabet. Another company we've added recently is MSCI, which they're known for the MSCI indexes, but they do data collection all across the board globally, both for financial companies, but also for other corporations that want to use the information that they've gathered. So whoever can gather and create unique data sets is going to matter, in my mind, a lot more than who can just click a button that anyone else can click. So you have to find that unique asset. I'm not sure if I'm right here, but there has to be a unique asset as part of your thesis, and a unique data set is one of the things we're focused on trying to find.
Yeah, I wasn't thinking about MSCI in the context of AI. That totally makes sense.
Yeah.
And so, Tony, we're really at the end of our interview. I mean, this has been wonderful. Appreciate the time. Enjoy Colorado. Think about me when you're hiking in the mountains. I will try not to think about you when I'm walking down New York City.
That's also a great place. Very different, but a certain charm to each place.
Good. Everybody can learn more about the Motley Fool Asset Management by going to fooletfs.com. Thanks very much, Tony, and look forward to, learning more and seeing your portfolios evolve.
Thank you. It was a lot of fun being here.
Thanks. Bye-bye.